Welcome back to Kansas City. Today, we are going to go through something that is a little bit deeper than most brokers would understand. But being that you're in level funded university, you are wanting to understand the ins and outs so you can best deeply serve your clients. And most of that, because insurance is based around trust, is having the expertise, the answers, or at least the ability to go get the answers when situations arise. Inside of level funding, there is a massive difference that we've talked about in multiple videos between a fully insured model and a level funded model. And that is the money inside of that pool is the employer's. It is the third type of money rather than the fourth type of money. Now, because of that, we have to do much more due diligence because we are using someone's money to pay the claims. In that process of doing the due diligence for the plan owner, we are going to go into claims to make sure that these claims are valid. There's a recent study that I saw that has the number of medical bills that have errors on them over 75%. Whenever we go through bills, we will look for any redundancies, double billings, and things along those nature. Whenever you have, as a business owner, your accounts payable going through and saying, is this a legitimate charge or not? They'll find something every once in a while. With medical bills, you find these things constantly. Now, most of these are caught during the bill review process, and we catch, hey, they're billing for this and this. They can't coexist. They're billing for this 3 times, but in different places. Okay, that's fine. We can catch a lot of that aggressive billing practice inside of that. What happens when we have a larger claim? Well, because we're dealing with the third type of spending, we're going to dig as deeply as possible into that to make sure that it is a valid expense for the plan owner, and therefore qualified, if it needs to, for excess loss reimbursement. So with that, there are about 4 things that we're going to cover that brokers will run into from time to time. Now, this is only generally on large claims that you get these, but we'll explain what they are, why we have them, and how it protects the plan to do it this way. Number 1 is the actively at work clause. Actively at work says that the member has to be actively at work at the company. Now, that can be defined as a number of hours per week or a number of hours per month. So, in general, if you have a claim that comes in and the person has not worked in, let's say, 9 months, but is still on payroll, then that person would not be eligible for the plan because they have to work. And there's different plan numbers for different plan documents, but in general, it's 30 hours a week. They have to be full-time to be eligible in broad strokes. If that member has not worked for months and months, then that member is not entitled to be a member of the plan. Therefore, they are not valid. Therefore, the claim is not covered. Now, why is that important for you as the broker? Well, the number one thing that it does is it protects your plan from anybody putting their brother, sister, cousin onto the plan so that they get coverage or they get access to reimbursements for their medical conditions rather than actually working at the company and having it be a benefit. Again, we are looking for self-funded insurance or self-funded plans to run as this is a protection against the unknown. This is not a protection against known expenses. So when you do an actively at work clause, what we are trying to do is trying to make sure that no one is gaming the system with the employer's money or stop loss money to put somebody on there to cover something that they know is going to happen, but they actually don't want to work at the company to do it. That is the actively at work part of the claims review process. We'll catch 1 or 2 a year where somebody put their brother, sister, cousin on the plan where the person doesn't actually work there, or they worked 1 hour. And they put them in the plan, and then they try to game the system to take money out of other people's pockets to subsidize themselves. That's not how self-funding and level funding works. Number 2, we have accident questionnaires. Now, you might ask, why do we have an accident questionnaire? Well, most of this has to do with a thing called subrogation. Subrogation says that although there is a valid expense, that valid expense is shared by multiple institutions. So think about car accidents. When you have for example, a car accident, some part of that claim with a medical claim, some part of that claim is the responsibility of the health plan, and some part of that claim is the responsibility of the auto insurer or the P&C carrier. When you have an accident questionnaire, you are able to coordinate those things for coordination of benefits. That is a very simple example. Another example would be, and this happens more than you know, you have a dependent unit who is covered under let's say a mother, and they're divorced. The mother and the father are divorced, at which point both of them are offering coverage for that child. Which plan is actually on the hook for that claim? That's what coordination of benefits does. And at that point, then you'll go through, and it's Robert's Rules of Order. The parental unit that has the first birthday will be on the hook. Their plan will be on the hook for that medical claim. So because we are dealing with the employer's money, we want to make sure that someone else or some other institution is not on the hook for the employer's money. We are protecting the employer's money as best we possibly can. The next piece that we're going to cover is another part of the large claim adjudication or the large claim processing system, and that is legal status of the member. Now, most of this is caught up front. So during the underwriting process, we will go through, and if someone does not have a social security number, we will make sure that they are entitled to the protections of ERISA. And in order to do that, we have to have either a valid visa or we have to have some other reason for them to be in the nation legally. If they are not here legally, ERISA does not protect them. So if you allow that member onto the plan, you run the risk of stop loss in a large claim situation saying, no, thank you, which puts the employer's money in jeopardy. So because of that, what we do is we make sure that the person is here in this country legally so that the plan owner does not have any excess liabilities because of the protections of ERISA only applying to people who are in the nation legally, whether that's a native born or someone with a active and valid visa. Additionally, there is the legal status question of covered dependent units. Now, a lot of that has to do with marriage. This is a more common issue in that people are less likely today, as they were in the past, to take the spouse's last name. Because of that, if you have a large claim, stop loss is going to say, is this actually a valid covered member? Because are they legally married? Remember, marriage is a contract between those two parties. So with that, we're going to go through and say if they have different last names, are they actually married? Now, most of these situations only arise if you have a large claim. But if we do not do our due diligence, we run the risk of poorly administrating your client's money. And that is something we take very, very seriously. So whenever you have a large claim that comes in, realize these are a little bit more work. And because people don't have large claims from every day of the week, this scares your members. So if you can coach them through as to why, saying we need the actively at work clause because we're looking for people who are trying to game the system and game the money of the employer and stop loss. Or the coordination of benefits, we're making sure that there's not some other P&C carrier or some other institution that would be on the hook for a portion of those claims. Or legal status, when we are in the underwriting process saying we need to make sure that this person is here legally or that they are actually married. Now, some states you have common law. But with that caveat, these are protections that we put in place to make sure that we are paying claims only when they are actually justified. So when you have members who are experiencing a large claim event, then when these questionnaires go out, they need to be filled out. Nothing would be processed without it. But these are the reasons why. So if they're valid, if they're actively at work, if they had an accident or whatnot, fill it out, send it back in, and we will process it accordingly. And we also are able to offer better and lower rates so that everybody can have the protection against the unknown risk that everybody so desperately needs in our great nation. All right. With that, any other questions, let me know. If it's a great enough question, we might even do a video on it. All right. We'll see you out there. Keep fighting for Main Street.